All right. Welcome, everybody, and happy Friday. Before we start, let me tell you about who we are and what we do and who we serve. We are a 25-year-old boutique wealth management planning firm headquartered in downtown Birmingham. In short, we help individuals and families live the best life they can with the resources they have and the health and time that they're given. There are three primary lanes to our process: investment management, financial planning, and tax planning. Today's call will cover some of the financial and tax planning areas. Let's start by rereading the title of today's workshop. Is having a large IRA a problem? Question mark. At first, this might seem like an odd question, as conventional wisdom has told us all along the way that yes, we want to have a large IRA. Well, sometimes conventional wisdom is not always the right. And today we're going to be the antidote to this conventional wisdom that having a large IRA account is not necessarily a good thing, and quite frankly, can be problematic. More importantly, we're going to talk about some of the solutions that go into this problem. So for any questions that you might have, please use the Q&A area. And then you can type in your questions, and at the end, we can address those. So here's an overview of today's call. There are 5 areas where proper tax planning can make a difference, and in some cases, a very big difference. We believe that from a 30,000-foot look over wealth management planning, tax planning is an integral part to that process. Over the past 30 years of providing wealth advice and thousands of conversations I've had with folks, I don't think I've ever heard somebody say that they wanted to pay more taxes than they should. And conversely, I've heard countless complaints about the amount of taxes that they have to pay. So our clients have something in common, and I'm sure this is common for many. Our clients want to save on taxes and keep that capital working in their family portfolios. So we feel that tax planning is critical for clients we serve. All right, so just in case you did not see enough polls and results over the past few months, I have another one for you here, okay? So we're going to ask this question about, have you converted your traditional IRA to a Roth IRA? And let me give you the ability to answer the question. Here we go. So go ahead. There's no right or wrong answer here, but it'd just kind of be interesting to see who in the audience has converted IRA money to Roth IRA money. So the questions are coming in. I'll let everybody complete. Take a second or two. All right, for the people that have answered, it's interesting. So 50% said yes and 50% said no. So interesting. We asked this question because you'll hear a lot about Roth conversions mentioned several times throughout today's calls. All right, let's get into the meat of the call. Critical area number 1, large IRAs create large RMDs, which, can be a burden for life. So, but let's start by getting a refresher on what an RMD stands for and what it is. RMD stands for required minimum distribution. When you get to a certain age, you will be mandated by the IRS to take out a certain amount from your IRA account, pay income tax on it, and do this every year for the rest of your life. The variables that go into determining that amount of your RMD is based upon the value of your IRA account and your life expectancy that year. And to be clear, when I use the word IRA, I'm also referring to other accounts that are subject to RMDs, such as 401k plans, 403b plans, 457 plans, SEP accounts, simple plans, defined benefit plans, and profit sharing plans. So let's follow the first arrow on this page. It used to be that no matter what your birth year was, you'd have to begin these required minimum distributions at age 70 and a half. Today, the required beginning date is bracketed to the year that you were born. So, for example, if you were born, January 1955, your required minimum distributions would start at age 73. So, how large is a large RMD, right? Let's look at the bottom left chart, which will show some examples of what an RMD would look like given a $2 million IRA account value. For somebody whose required beginning date is age 73, they will be required to distribute approximately $75,000 from their IRA that year, and the number will only go up from there. Let's hypothetically say that at age 83, the IRA account is still valued at $2 million. That RMD will now be approximately $140,000. Now, this is assuming that at age 83, the IRA is still valued at $2 million. However, there's most likely a good chance that it's greater than $2 million, which means that RMD is going to be greater than $140,000. Point being, the RMD amounts are going to continue to go up. Now, for some, that may be exactly the income needed to supplement other retirement income sources, such as pension income and Social Security income. But what if you don't need that extra income? More importantly, what happens if that extra income is pushing you into a higher tax bracket, and now you're paying higher taxes on that income you didn't even need? So off to the right here, you'll see a few bullet point mitigation strategies. You can, balance your contributions going into your 401k plan, which means, today's most plans have 3 buckets to contribute to. You've got the pre-tax bucket, you got the after-tax bucket, and you've got the Roth 401k bucket. The traditional path is to have all contributions go into the pre-tax bucket, thus building that large IRA account that will, someday have large RMDs. With proper planning and utilizing those other buckets, you can limit having too large of an IRA. Number 2, with regards to the after-tax contribution bucket in your 401k plan, you can convert those after-tax contributions to a Roth IRA account while you're still working for the company and do 2 things. You can get those after-tax contributions now growing tax-free inside the Roth IRA versus tax-deferred inside the 401k plan, big difference. And you can also limit the 401k value in the future used in that RMD calculation. Here's an important note too. Roth IRA accounts are not subject to required minimum distributions. Number 3 mitigation strategy. Early retirees can find themselves in a lower tax bracket during those years leading up to required minimum distribution age. This time frame can be a sweet spot for paying lower taxes on Roth IRA conversions by converting prior to RMD age you are reducing your traditional IRA account value to make those RMDs smaller. In summary, if you're in a position where your IRA account is or could be in excess of, say, $1.5 million, know this: there are strategies available to you today that can help mitigate ending up with a large IRA account producing large RMDs. Oh, yeah, another poll here. Fun, right? So here's another question for you, and let me go ahead and provide you with the ability to answer. Again, no right or wrong answer here, but just kind of be interesting to see what everybody's take is on current tax rates. So I got a couple more. Okay, they're coming in here now. So I'll let everybody hit yes or no. And all right. So interesting. It's not a split decision here. 100% of you, which is interesting, 100% say yes, that they think that tax rates are going up in the future. Okay. So let me end that, and getting to the next slide here. No one has that crystal ball to foresee the future, but this chart on the left in red can tell us quite a bit about where the highest tax rates have historically trended and can give us a fair idea of where they might be heading. The highest marginal tax rate at the end of World War II was 94%, and it remained elevated into the early 60s. That all changed with Reagan when he slashed rates, resulting in the highest tax rate plummeting down to 50% in 1982. Since 1987, that highest marginal tax rate has remained low, never rising above 40%. So one situation that stands in the way of keeping those rates low is the fact that our U.S. government debt currently stands at $36 trillion. Big number. The interest payments alone are higher than the payments made out on our defense today. This has never happened in U.S. history. This is a growing problem, and quite frankly, we believe it to be a ticking time bomb, and certainly gives the government ample reason to raise taxes, especially on those higher tax rates. Chart to the right talks a little bit about TCJA, stands for Tax Cut and Jobs Act of 2017. You can see where the rates are today, and that's on the left-hand side, 2024. And on the right-hand side, that's the rates that they're supposed to go to or sunset to come January 1st, 2026. That is, unless the Congress intervenes between now and then. And, again, if there's any bill proposed or passed before January 1st, 2026, we should not be surprised that the focus will be on raising those higher marginal tax rates, possibly higher than what you see on this chart. So in summary, I'm not trying to be an alarmist, but we believe tax rates are probably not going any lower than what they are right now. So what can you do? With proper tax planning and scenario analysis, you can be proactive. Consider accelerating the taxes you pay on these IRA distributions at lower rates than what you would pay in the future. All right, critical area number 3. And here's a critical area that many of us often don't think of. Why? Well, probably because there's some sort of level of complacency, and let's be honest, death is something that we don't want to think about. But here's the reality of it with an example. Mary and John have an income of $250,000 and are in the 24% tax bracket. one of them is most likely going to predecease the other. When that happens, the surviving spouse will move from married filing jointly to the single file tax rates. In this example, the surviving spouse, let's say that's John, will go from the 24% tax bracket to the 35% tax bracket. And, here's some other implications for John's situation too, right? Although the household Social Security income will be reduced to the higher of the two spouses' benefits, John now has a lower threshold for paying tax on Social Security income, and he has a higher single filer rate on that Social Security income. Another implication to John must continue to take those larger RMDs, which will be subject to higher single filer tax rates. Number 3, the standard deduction for John and Mary is now reduced to one standard deduction amount, which will lead to higher adjusted gross income for John. And we're not done there yet. Number 4, John may end up paying higher Medicare premiums now that he's filing as single. So in summary, a surviving spouse who goes to the single filing tax rates will add approximately 8 to 10% to their tax rate. If you, like many of us, do not want to leave your loved ones in a worse situation, then converting those IRA accounts while you're alive could help mitigate the additional taxes to the surviving spouse. So that's the widow's penalty right there. Number 4, we just talked about potentially leaving a surviving spouse in a worse situation. How about the idea of leaving your children in a worse situation? Here we're going to talk about the idea of leaving a large IRA to a non-spouse, such as children, and the potential tax situation that they may find themselves in. Well, the Secure Act of 2019 was a game changer for non-spousal beneficiaries and how they inherit IRA accounts. Before 2019, non-spouse beneficiaries could stretch out the required minimum distributions based upon their life expectancy. And, this allowed the beneficiary to take smaller distributions, most likely at their current tax rates, and it allowed that IRA to stretch to potentially provide a legacy to their beneficiaries. So, this all changed in 2019 with the Secure Act, which did away with the stretch strategy and mandated that the non-spouse beneficiary empty the inherited IRA account within 10 years of the date of death of the original IRA owner. So the time frame for when the distributions need to happen has been definitely compressed. This now means that in some cases, higher tax rates on those inherited IRAs, possibly much higher tax rates if the beneficiary is gainfully employed during those 10 years of distribution. So, solution: the original IRA owner, while alive, and preferably when they're retired with no earned income, no RMDs, should consider a Roth IRA conversion strategy, moving some or all of their IRA money to a Roth IRA account. Now, here's an example using some of the software that we use in-house, showing how a Roth IRA conversion can be of benefit. You've got investor A off to the left, investor B off to the right. They both have $2 million in IRA money. Investor A does not convert any of their IRA money to a Roth IRA. And investor B decides they're going to convert whatever is available up to the top end of their 12% tax bracket between the ages of 62 when they retired and 74 when they're going to have to start RMDs. And you can see that investor B is projected to create more wealth and pay less taxes over their lifetime. So this is good, right? Another good thing is that if you look at the chart on the right, the orange represents Roth IRA money. This money will ultimately be transferred to non-spouse beneficiaries tax-free. All right, the fifth and last critical area where tax planning can make a difference is making sure that your estate plan is current and relevant to how you want your legacy to go. So, like the widow's penalty, this area involves talking about planning for an event that is not very comfortable. We've all heard this before, and it was Benjamin Franklin who said, death and taxes are certain. Another reason why perhaps estate planning has not received as much attention as it should lately is that with the passing of TCJA in 2017, the exemption level for paying estate taxes for a married couple is $27 million. That kind of number puts many folks at ease from having to do any sort of creative estate planning to get that estate below that exemption level. So with TCJA expiring at the end of 2025, those exemption levels are due to sunset back to considerably lower amounts than they are today. This will create, if not already, urgency for proper estate planning so that the family can transfer that wealth the way they intended and limit the government's share of that family's wealth. So in conclusion, and yes, we went through a lot of information quickly and in a short period of time, but here's a summary of some key points to remember. While you're reading through those points, I'm going to take a look at the Q&A section and see if we have any questions that need to be addressed. Give me a second here, Q&A. Right. There's a few questions that are queued up, so I'll get to those. Let's let everybody kind of read through those 5 key points. For those of you who want to, how are we doing on time? So, I kind of quickly went through this. I said it was going to be 30 minutes. We will do a recording. This webinar is being recorded, so we'll send out the recording if you need to go back and revisit it. For those of you who want to stick around for the Q&A, feel free. For those of you who need to leave today's call, we thank you for attending, and hopefully you learned something new. So let me see about questions here. Next page. Okay. So yeah, we do have some questions. Okay, first one. Do you have to mandatorily distribute income from a Roth IRA account? No, we mentioned that earlier, but yeah, that is certainly an advantage to a lot of what we talked about today. So Roth IRA accounts do not have required minimum distributions. Okay. All the reason for thinking about if you're getting into a situation where you have a large traditional IRA account that's going to create a lot of the problems we mentioned today, think about converting some of those IRAs to Roth IRA monies. I have not converted any of my IRA money to a Roth IRA money. How much should I convert? That's another question. So, it really does depend. We've run a lot of different scenarios where it shows, it's a no-brainer for that family to start converting or implementing a Roth IRA conversion strategy. And we've seen other cases where, and we use software to do this, but we've seen cases where, it actually ends up increasing their lifetime taxes and decreasing their assets left to their heirs. So in that case, obviously, converting IRA money to Roth IRA money wouldn't make sense for that individual. So, but good question. You didn't really talk about the markets, but how do you feel about the current market and what is your outlook? So, yeah, you're right. We didn't talk about markets. We did talk more about strategy and planning. Yes, but markets are a big part of what we do, and managing money is a big part of what we do. But we're certainly Up until this week, we were sort of in that, Trump bump, they called it, where the market has gone, a little bit extended, a little bit further beyond what people expected. But, I think that the market overall, it has a lot to do with our economy and how our economy is growing. It has a lot to do with, where interest rates are. Our outlook, which we will be putting a webinar together come the beginning of next year, that'll talk about the outlook for 2025, but I think you're going to see, much of the same. There might be some rotation within some of the equity market. You've got 7 companies of the S&P 500 that provided 60% of the gains for the S&P 500 this year. So, very concentrated. I think that those 7 companies will take a breather, and maybe some of the other 487 companies will gain some attention next year. But overall, we still think the equity markets have room to go, although I would love to see the market move sideways for a while and digest the move here over the last couple of years. So, all right. I know you, no, I already went over that one. Okay. I am maxing my 401k plan all pre-tax. How do I know that is the right and only bucket? So we did talk about that, right? You've got 3 different buckets to choose from in most 401k plans today. And yes, the traditional path was all pre-tax, and that does lower your taxable income for the year. But, you're maxed out at, 23,000, and I think it's 30,000 if you're over age 50. So it's there's not an exact science to the balance, but you can certainly run some projections on what that traditional IRA account will look like, which is money's coming from the pre-tax contributions. And if you find yourself in a situation where you're getting up to $1.5, $2.5, $3.5 million IRA account by the time you retire, maybe today you balance those contributions a little bit more towards the Roth piece or the after-tax piece. But yeah, I mean, running projections, I think, is probably a good idea for figuring out what that balance of contributions should be. And by the way, between those 3 buckets and the company match, so there's technically a 4th bucket there, we're all limited to $69,000 going into that 401k plan annually. So, that's a lot of money. And a lot of that is after tax, which can be, converted over to Roth IRA money, while you're still working. 2 more questions here if you want to stick around. Is there a situation where Roth conversions don't work, and why? Yeah, and as I just mentioned, we use software to figure this out, and every case is different to a certain degree. But yes, we've seen plenty of situations where we think converting IRA money to Roth IRA money is the end all and the be all, but come to find out for that individual, it actually puts them at a disadvantage. So it's not for everybody. How will a large IRA or distributions impact my Medicare premiums? So, yeah, great question. Age 65, you go on Medicare and you start paying premiums. And yes, those premiums are deducted from your Social Security income, or can be deducted from your Social Security income. But yeah, you want to be aware of where those Medicare, they call them IRMA premiums, right? This is additional premiums to the base premiums that you would pay on Medicare if you're earning, certain amounts of income annually. And, there's a 2-year look back on Medicare too. So just because you take an aggressive stance on converting some IRA money to Roth IRA money, and yes, it bumps you up into another bracket, but you recognize the long-term impact of that strategy, and it does increase your Medicare premiums, you can always go back, and once you get back to where you were, and reset that Medicare premium back down to hopefully the baseline amount. Last question, okay? Will doing conversions have an impact on my Social Security and taxable income? Yes, it may. Certainly on the taxable income, it will, right? Because anytime you convert, you're creating more income than what you already have coming in that year. So again, that example I put up there about that individual converting up to their 12% tax bracket, or if you're in the 22, up to the 22, there's usually some room there where you're not paying any additional taxes on that converted amount. And then as far as Social Security is concerned, you do pay Social Security income tax if your Social Security, if you're filing single, it's I believe it's anything north of $25,000 in Social Security income, you'll start paying some tax on, I think at 25,000, it's like 50% of that Social Security income will be taxed. And then if you're over 34,000 filing single, 85% of that Social Security will be taxed, again, at your income tax rates. So there's other income that's probably involved in your tax return to figure out what your rate is. So all good questions. I don't see any more. If you can see my contact information in there. My name is Chris DeWolf, and I'm one of the two founders of the investment consulting group. We have a team here of Christy, Spencer, Elena, and then there's others on my partners team. So if you want to reach out to me individually, there's my email address. Or there's a phone number there too. You're more than welcome to give me a call or message me on LinkedIn. We're pretty involved with LinkedIn. So anyway, I've taken up enough of your time. Actually, it's 30 minutes, right at 32 minutes, right on the button. So hey, thank you for joining. Hopefully you learned something new today. Hopefully something that you can take and improve on your family situation. And until the next webinar, have a great rest of the day and a good weekend. All right. Thanks again.